So what do falling interest rates mean for the property market? Well, the RBA is on a cycle now with reducing the cash rate to the overall economy. So what is the cash rate? Well, the cash rate is the interest rate that gets charged to the commercial banks. And at the moment, this is sitting at 3.6%. Then the banks have to make a little bit of money or a lot of money, and they have to charge a margin in between to cover their costs and to make a bit of profit. So let's call this 2%. So we've got the cash rate sitting at 3.6% plus a margin of about 2% in between. That gives you a total of 5.6%, and that's what you and I pay on our mortgages. So when the RBA cuts the cash rate, they're cutting the interest charge to the banks, and hopefully the banks will pass this on to the consumers. When they're cutting this cash rate, it actually gives you more serviceability. So you can go out there and borrow even more cash to get even bigger loans. So what the RBA is trying to do is stoke demand. They're doing exactly that by reducing interest rates, giving more cash to people to go out there and spend. Hopefully they will go out there and spend, get bigger mortgages and keep the cycle going. The thing is, when you have a housing shortage, so you haven't got much housing stock out there in the market, you have all of this demand coming through, naturally this is going to push house prices even higher. So the same goes for investors who are chasing capital growth and yield. It makes property even more attractive because the cost of interest is lower. So then they also go out into the market and they're competing with the homeowners as well. So you can see this is a perfect storm, and the only way to fix the housing market or the property market is to actually bring more supply online.